And the key thing I'll end with that's so important we need to point out is cryptos are showing divergent weakness now. This is on a quarter, on the whole quarter now. Q2, the Bitcoin's down 6-7%. Bloomberg Galaxy Crypto Index is down about the same, and the Nasdaq's up about almost 10%. That's a sign of divergent weakness. I think it's just a matter of time. The markets will make it happen. Then your your risk-off trades like gold and bonds should kick in. Yes, I've been way too early. But the thing is, we're pointing out now is Bitcoin, number one, least risky crypto, is still pointing to risk off. Yeah. And that's what I'm looking at as a signal. I'm kind of concerned about it.
As the United States economy approaches a recession, marking the first significant downturn since Bitcoin's inception in 2009, Mike McGlone, a senior macro strategist at Bloomberg Intelligence, cautions cryptocurrency investors to brace for further challenges. McGlone advises prudently reducing exposure to risky assets due to the anticipated surge in volatility. Regarding Powell's actions, it is worth noting that he subtly indicated that the recent interest rate hike, surpassing 5%, might mark the conclusion of a cycle that has gradually increased borrowing expenses since the previous year's near-zero levels. While acknowledging widespread backing for a 25 basis point rate increase this week, the Federal Reserve Chairman hinted at a potential pause in their tightening efforts come June. According to McGlone, cryptocurrencies are encountering multiple challenges, including the onset of the first U.S. recession, a potential stock bear market, increased scrutiny from central banks, and intense competition from high interest rates. However, the fact that they have rebounded in 2023 suggests a consensus belief that the worst is behind us. As per his analysis, the potential onset of a recession poses a significant hurdle for Bitcoin, possibly the most substantial challenge it has encountered since its introduction in the late 2010s. The crypto community is expressing concerns about the impact on the digital currency market, particularly with predictions indicating that economic activity may begin to decline from July onwards.
Big U.S. banks face 20% jump in capital requirements. It's like, I'm not going to bother to click through that story. I just look, okay, the macro is already bad. We're already seeing a major jump in money leaving banks and going to money markets and two-year notes. And it's classic fractional reserve bank contraction. It's just, you can't face it. It takes a while. And then I see that headline, okay, well, let's just throw gasoline in that fire. So I just don't, it's one of those things that also you have to also remember in this business is very important to focus on the forest of what you're looking at and ignore those little trees that'll knock you off your view. And that's what I see. The stock market's a pretty good tree lately, but it is actually, I think, aggravating my macro view that this is the biggest reset of a lifetime by keeping that Fed emboldened, by keeping those rate hikes still hanging on over ahead, as so many other things are collapsing. And the people focus on the lagging things like unemployment. That's so not important. Let's look at the producer price index. The fact since 1948 it's never dropped as fast as it is now, and then I say that as a fact, should scare me. It should scare everyone. And what is being done to help alleviate that? Nothing. It's still going that. And the fact that we're having bank deposits on a year-over-year basis drop at the biggest, the highest rate in our database since the 50s. And what's out to stop that other than maybe just a pinprick every time one or two banks fall? Nothing. The macro's still bad. That's why I look at the big picture. You have to think at least 12 months forward. And that's where I'm still concerned that you see the Fed funds rate 12 months is still around 5%. And that's still restrictive because if I'm going to get 5% and guaranteed 10% in 2 years, why would I invest in any risk asset, particularly if you start rolling over it? Cryptos have been doing. Right now, we're more significant thing is that bridge is this big recession, the Fed's still tightening, and maybe it's going to aggravate. But remember, we're with the enormous privilege of the world's base currency, enormous privilege of, not so much a privilege, we've earned the right, we protect the world. I mean, just imagine this little veil in Europe, we had these tanks coming down from Russia. Just imagine US says, okay, yeah, we're kind of done. You guys are on your own. It's just the strength of what the US can do and to support its currency and its dollar and our treasury market so deep is just impeccable. So I'm not worried about that. It's just be careful with those little nuances about this.
McGlone says that the worst may not be over for Bitcoin, predicting a liquidity crunch in the second half of 2023 due to a U.S. recession. According to the McGlone, Bitcoin's peak at approximately $30,000 in 2023, compared to the 100-week average of around $33,000, could indicate a notable shift in the globally traded risk indicator. This change might reflect a departure from the comfort zone around $7,000, which prevailed prior to the unprecedented liquidity boost observed during 2020 to 21. The anticipated U.S. recession, which has not materialized yet, may exert pressure on risk assets in response. When it comes to how Bitcoin will fare in a U.S. recession as compared to gold, McGlone said that the high probability of a U.S. recession and tendency for gold to shine in such conditions may favor the metal in second half versus Bitcoin, with its nascent risk asset status. In the emerging era of AI might compare crypto with AI. In his tweet, he said, Bitcoin's $1 trillion ceiling may guide NVIDIA down about 5% in 2Q. High beta Bitcoin shows little endorsement of the roughly 10% jump in the NASDAQ 100 stock index, of which NVIDIA is ranked fourth in weight.
The Fed is going to, by July, there's a 55% chance they're going to raise rates another 25 basis points. It doesn't matter the exact percentage. The point is they're still tilting towards raising rates. Why? Because they're following inflation data that's very sticky. Personal consumption expenditures, employment cost indices, all driven by homeowner's equivalent rent and things like that. That my economist Anna Wong says her models are saying they're supposed to start tilting towards cutting, but they can't because they're still following these lagging inflation metrics, which is the key thing that's part of the lose-lose from McGlone. It's very rare you'd ever see this, but they cannot ease with the ease they have until markets make them. Or we have this long delay, which would be wonderful. And that's where I think cryptos are starting to trickle down or saying, okay, guys, there's a problem. Collapsing commodities are pointing out clear deflation, but the Fed has to ignore that until their data shows we're okay. And I think they're going to flip on a switch, but that's why it's still not happening. We're still not seeing that give from the stock market. That's the number one thing that I see right now. We're priced for this 55% hike by the time we get to 25 basis points, by the time we get to the July 26th meeting. And I want to point out on July 13th, we're going to get the producer price index, which is probably going to show negative year over year. And just the fact that the Fed's still tightening with them that number dropping the fastest ever. Now it's a high beta measure inflation. Is to me, it's classic. Like we mentioned, I think Mr. Powell's going to go down in history as person who helped aggravate this great potential depression, and only because of he just happened to be in the wrong place at the wrong time and just didn't catch the inflation early on and didn't start cutting. But now there's that consensus that he has to keep tightening. The market's priced for it, yet there's a lot of reasons that and he's stuck. There's nothing he can do. That's the lose-lose. He can't really cut now because if he's wrong, he loses. And in this case, if he's right, I think we're going to get a collapse in inflation. But that's already started. The debt ceiling, it's clickbait. It's completely insignificant the amount of this or that country that might be buying U.S. or selling U.S. Treasuries. U.S. Treasuries are the world's highest yielding debt, the deepest market right now. If you're short the dollar, it's a negative carry trade. It's not that complicated. And I've heard it since I've been in this business. I don't know how many times, I got to short Treasuries because the debt's going up. First of all, let's start with the trend. It doesn't matter right now. We're all turning to Japan. It will matter at some point. That's why Bitcoin is long-term I'm bullish. But right now, the biggest bridge that we have to cross is, as Dave mentioned, we're tilting towards this recession. What typically happens in recessions is the Fed cuts aggressively. This is not an opinion, that's a fact. And yields drop a lot. And the trend in yields for 40 years has been down with a blip. The trend in crude oils for a long time until 2008 has been down. We had a blip back down. So also that's just the fact, things I've heard forever. Like when people talk about owner's equivalent rent, I remember talking about that in the 80s. And now it's at the highest ever. It's just going back down. But I want to tilt back a little bit. We need to just put a little closure on that. That when you have boomers and anybody in the planet who can get 9% guaranteed in the world's deepest treasury market for next 2 years, okay, it's 4.5, so 2 years guaranteed, that's just a major suck of money and liquidity from all risk assets. Bitcoin starts going down and NVIDIA is breaking out. And I compared the market cap. So we all remember when 2 years ago, Bitcoin peaked just above 1 trillion. I think it's 1.3 max, and we're having that really battle with NVIDIA now. So I compared the market cap. Right now, NVIDIA is about it's 50% or so of the market cap of Bitcoins, 50% the market cap of NVIDIA.
Yeah.
And
Total
that's the
crypto is 1.1 now.
There
Total
you go.
crypto
So
is 1.1.
the
Yeah.
lowest since 2017. And so this is the fastest horse in the race. It's a lot of it's, we know, massive amount of speculation, in some areas less, like Bitcoin. And it's been trading lower, a lot lower in the last month, as we see the Fed tightening more and the economy doing better, right? Isn't it? According to the stock market, to me, that's the classic divergent sign. You'll look back from the future and say, yeah, that was a bell ringing.
Recessions encompass more than just employment fluctuations. However, the robustness of the labor market and its implications for consumer spending play a pivotal role in determining whether the U.S. economy is expanding or contracting. Certain economists have proposed that a 0.5 percentage point increase can serve as an early indicator of an impending recession. Despite this, the current overall unemployment rate of 3.7% signifies a highly competitive labor market, approaching full employment according to certain metrics. The question of how the markets will respond as the United States heads toward a recession is on everyone's mind. We appreciate your feedback, so please share your thoughts in the comments section below. If you found our content informative, consider subscribing to our channel and enabling the notification bell for regular updates. Thank you for watching.